Welcome back to my channel where we do a deep dive into personal finance and strategies that may be helpful for you. Today, we are looking at index universal life policies, and we're going to talk about the different benefits and the downsides to make sure you understand exactly how they work. Let's start with the basics. Index universal life insurance is a policy that combines the death benefit protection with the ability to grow a cash value similar to whole life insurance. The difference being whole life insurance has a level of guarantees associated with it, whereas index universal life policies grow based on the performance of a particular index in the stock market without actually being invested in the stock market itself. This unique feature allows for potentially higher returns with a unique twist that minimizes the downside risk. The growth of the cash value in an IUL primarily depends on the stock market index it's linked to. However, it's not as straightforward as investing in the stock market. Let's break down the main components that affect growth. Participation rates, caps, spread, and of course, the floor. Participation rates. This is the percentage of the index's gain that will be credited to your account. As an example, if your participation rate is 80% and the index grows by 10% for that year, you will see an 8% increase in your account. Next, we have caps. These are the upper limits that your policy can earn during a certain period. Even if the index skyrockets, your gains are capped at the predetermined level, say 12%. Next, we have spreads. This is a percentage of the index's gain that is deducted from the overall return before it gets credited to your policy. As an example, if the spread is 3% and your policy earns 18%, you're going to be credited 15%. Finally, we have the floor, and this is probably the most appealing aspect because the floor is going to sit either at 0, 1, or 1% depending on the insurance company you're working with. The floor protects you from getting a negative return. If the index goes negative 20% for the year, you're going to experience a 0% return, or if you're working with a different company that offers a 1% floor, you'll get a 1% floor. Now, it's important to note that the way that the policy is structured is incredibly important. You want to make sure the policy is structured for high cash value accumulation. Make sure that the death benefit is as low as it can go according to the guidelines set by the IRS, and make sure that you're overfunding the policy to the maximum limit right up to that guideline set by the IRS. This approach reduces the costs and fees inside of the policy, allowing more of your premium to go into building the cash value. While IULs offer their attractive benefits, they don't go without having some downside. Several factors can cause an IUL to underperform. First of which is the structure of the policy. Like I said previously, it's incredibly important to make sure that that policy has been structured by a professional who knows what they're doing and being maximized for cash accumulation. Beyond that, low participation rates and caps can affect the policy. These are variable and can be changed by the insurance carriers. So you want to make sure you understand where those caps and spreads are at, and you want to check in on that policy every year to ensure that you understand where those are at on an ongoing basis. Next would be high fees. Inside of these policies, the cost for administrative costs and death benefit fees can be pretty high, especially if your policy was not structured for high cash value accumulation. If your policy was not structured for high cash value accumulation, these fees can eat into your policy and eventually cause a lapse. The next challenge is interest rate changes. IULs are interest rate sensitive. Significant fluctuations in interest rates can cause problems inside the policy. And lastly, market volatility. If you have consistent negative returns in the market year after year, it's going to be difficult for that policy to perform. Even though you're not getting those negative returns, you still have a 0% floor. However, there are fees and costs associated with the policy every year, which again emphasizes the importance of making this policy built and structured correctly for high cash value accumulation. Because most of these things that I've mentioned can be avoided and won't be a problem if the policy was structured correctly. However, it's important to check in with whoever your agent or advisor is that structured this policy for you to make sure you understand all of these different things happening every single year. Check in on the policy, make sure it's performing the way that we need it, make sure that there's no changes that need to be made. In conclusion, index universal life policies offer a unique blend of life insurance protection and potential for cash value growth linked to market performance. They come with features like participation rates, caps, and a guaranteed floor that provide a balance between growth potential and risk management. However, it's essential to understand the nuances of these policies and make sure your policy has been built for high cash value accumulation. As with any financial product, make sure you ask all the questions you can. Make sure you're talking to a professional who specializes in this area. As always, you're welcome to check out our website, moneyinsightsgroup.com. We have a ton of education material on there, and there's also a ton of videos on the YouTube channel that you can check out. Thank you for tuning in to today's video. If you found it helpful, make sure you hit that thumbs up button. Make sure and subscribe to my channel. And if you have any questions, drop them in the comment section below, and I'll try and respond to them as quickly as I can. Until next time, keep your finances in check and your future secure.